Hello and welcome to this week's Fit Finance Sessions with myself, Tom Senegals, and Henry Elliston.
Hello, how's it going?
And I think this week we're going to start off with a bit of an update on the property market. I think it's been quite buoyant over the summer, lots of people moving houses, and I think Henry's going to sort of recap on what's going on and maybe what's ahead for us on that basis.
Yeah, thanks, Tom. It's been quite interesting, hasn't it? So we're in this recession. People are worried about their jobs. People are worried about whether they're still going to have a job at the end of the year if they have still got their jobs. And yet, I see in the papers this morning that property prices have now hit their highest level on average ever. So the average new selling price for a house is over £323,000, which allegedly is up 1.1% since last month, and over 5.5% since this time last year, which is huge growth given the current economic situation we find ourselves in. And it comes, and in spite of the fact that actually a lot of mortgage lenders, especially for first-time buyers, have restricted their lending. So loans with 5% deposits or even 10% deposits have been very much restricted, making it harder for them to get on the ladder. And so I suspect that a lot of this has come about for two reasons. One is the stamp duty holiday that the Chancellor has provided, which, as a reminder, is so you don't pay stamp duty now up to £500,000. So from naught to £500,000, stamp duty rate is 0%. And no doubt that has driven some people into buying properties and getting on the ladder, or not getting on the ladder, but buying the properties as quickly as they can. And also, I think there's been some talk about people wanting to move out of the larger conurbations, so out of wherever, London, maybe Birmingham, Liverpool, Manchester, to the surrounding countryside area. So they've got a bit more. If we're working from home, you want a bit of a bigger garden or a bit of a bigger room to call your study rather than working from your bedroom. So I suspect that those are the reasons that are driving it. And one other reason I suspect is that a lot of people, landlords especially, would have been granted bounce back loans by the Chancellor at the back end of the lockdown. And it wouldn't surprise me at all if a number of those people are using those bounce back loans to reinvest into property, which I'm not entirely convinced was what the purpose of the bounce back loan was. But nonetheless, if you're going to be given money on the cheap, why not use it to invest in something? I mean, if you're already a landlord, why not go and invest in more property? So it's an interesting thing, and I suspect that property prices probably continue to rise for the next 3 or 4 months. I dare say that the stamp duty holiday comes to an end in March, so it wouldn't surprise me if you see boom all the way up through until March. There'll certainly be a maddening dash to complete before the stamp duty holiday is removed. And your guess is as good as mine as to what happens to property prices next year. But I'm personally not particularly optimistic. I would sit back and wait for property prices to fall. I reckon your savings might be greater than the stamp duty savings you make right now. But that's, who knows? That's crystal ball searching. But that's why I played on the property market.
I have been hearing from people selling and buying properties in the market that actually people are just asking silly money because it's all been I guess moving forward or booming because of this stamp duty holiday. I think there is a bit of pent-up demand. I think it has been a bit flat for a while, and therefore people maybe who were thinking of moving and were sitting tight have probably seen, well, okay, it's going to save me 20 odd grand, I'll get on and move now. But yeah, I think it could start to slow down come the end of this holiday period. I guess whilst property prices have been booming, I think markets have been moving quite well, and hopefully there is talk of a vaccine from Pfizer, which should hopefully push markets further forward, because that would sort of signal a return to normal, and therefore companies can earn the profits and operate in a way that they're used to. How much of that pushes on, we don't know, but given a lot of government spending, lots of stimulus, a vaccine, I think and actually lots of companies probably adapting well and trimming where they need to. It probably puts them in a good state for going forwards. China in particular, which has come out of coronavirus probably a bit before everyone else and seems to be doing well. They had really good GDP data. Today they grew 4.9% year on year in the third quarter, which is a little bit behind expectation, but significantly better than before. And I think there is talk around, I know I've mentioned it in the last few weeks, around the election. Biden is tipped to win that election and probably gain control of the House and the Senate altogether. And that could lead to a bit of a headwind for corporate earnings in America. US equity, had a really good bump when Trump came in, put a lot of tax cuts, and that's just money on the bottom line to make values go up because they're earning more money. Could be the reverse come a Biden win. But I think you might see in more ethical investments, or particularly green energy, a Biden win would see shares in those sort of sectors win. So, and it doesn't mean it's a bad thing for normal energy stocks either. There could be some tighter regulation, but that could push prices up. So actually, commodities could benefit from a Biden win as well. So yeah, it's just about staying diversified, not having all your eggs in one basket, and we'll see what happens, but it keeps it interesting.
Yeah, correct. I think the other thing on the market front there is what's going to happen with Brexit. UK stock, I saw a report over the weekend, is now historically cheap in comparison to other stock markets around the world, and I think this is driven by a couple of things. One, COVID, but the other is this ongoing uncertainty around Brexit, whether we get a deal and how easy that deal is. And as yet, still, the news is it was meant to have happened, wasn't it already? Still no deal, but still they continue to try, and I think they're talking about having a fortnight where they all just get locked down in a room and they have to come out with a deal at the end of it. I think is the current idea. Really interested to see if it happens, and because I think a proper Brexit with a proper strategy alongside a vaccination will be a boom for the markets. I can really see huge growth. But I said back at the beginning of the year, I reckon the FTSE 100 would close at 6,500. I'm looking a long way short on that guess right now. But I reckon with a proper Brexit and as I say, vaccine, I might not be too far off. But we'll have to wait and see.
Yeah, I think definitely. I think if you think the FTSE was at 7,000 plus not so long ago, then yeah, 6,500 with a Brexit deal would be easily doable. And the companies in the FTSE 100 in particular are big international companies. They are making money largely overseas. I think 70% of their earnings come from overseas. It just tends to be that we have more of the industrial stocks, mining stocks, but there's big companies out there. I mean, we only have a minimal exposure to tech orientated companies, a bit like Ocado, but they're doing really well. So yeah, plenty of room to maneuver. And I know European stocks have been rising quite a bit as there's that worry over the US as well. So yeah, always optimistic. There'll always be bumps, but I think generally I think come middle of the next year we should be in a good place. I think that's everything from me. Anything else from you, Henry?
Not today.
Well, hope you enjoyed that quick update. We'll be coming out with some more content, maybe some more informative things around tax planning and other bits in recent weeks. So if you've got anything you want us in particular to cover, then please let us know and leave us a comment below the post on LinkedIn. Thanks very much.
Bye-bye.